want us to check that question. So the question said, Equip Agencies Limited purchased equipment for 4 million on 1st July 2008. Depreciation on equipment is provided on a straight line basis at the rate of 25% per annum. During the 4 years, from 1st July to 30th June 2012, the profit before tax and allowed wear and tear charges were as follows. So, Vera, it was a question. So Vera, someone is sharing it in the group, you can pick it from there. So we have so we have 1st July 2008. To 30th June 2009, all the way to 2012, we were given the profit before tax. Then also we were given wear and tear allowances we have been given. So required, they want you to give taxable profits, temporary differences, and deferred tax accounts. So let's start with the taxable profit computation we have shared. So those who are not having the question, you can check from the group. So taxable profit computation. How do you get taxable profits? You will take the profit before what? You add back, in this case, less specific, we add back what? The less. So start there. So profit before tax, this was well provided. What we need to check, I want us to check these two. I want us to check depreciation and also wear and tear. So depreciation, they were charging depreciation at what rate? 25% per annum on straight line. So this is 25%. The cost of the asset was 4 million. So cost of the asset, let's work in thousands. So this one will be 1 million. So that is depreciation per annum. Depreciation for every year. Then let's go to wear and tear. Wear and tear, the rate was not constant. Sure. The rate was changing every year. So the first year was the 40%. The year started in 2008, 2009. Right? So 2008, 2009, and just call it 2009 because it ends in 2009, 2010, 2011, went all the way to 2012. So first year was 40%. So of course 40% of the 4, 30%, 20%, then 10%. Those are the rates. Yeah, so the rates were 40, 30, 20, 10 for those years. So how much? 16. 12. 1. So half up that point. Yes? You attempted. Did you get those ones? We'll figure out. Let's continue checking. All right. So now we have everything we require to get the answer. So right there, what they call themselves equity. So equity agencies limited. Taxable profits. Obligation. So we have 209. (2012). So we say reported profit before tax. Reported profit before tax. Ilikuwa ngapi ngapi? So reported profit before tax is 800. 950. 850. Sure. Then you add back depreciation. Depreciation is uniform across 1111. So you add depreciation. You have depreciation. So depreciation, 1. Then you less wear and tear. Wear and tear is 16. 12. 8. 4. So whatever you get, is the taxable what? Profit. So get me those answers across. You know the figures. 200, 700, 1150, 1450. Thank you. So that was what was required from Roman 1, and I want to combine it with Roman 2. Roman 2 was current what? Good. Required Roman 1. There was no current tax. Look at it. So I want to get the current tax. So current tax, the formula, I'm going to define it separately. What I will combine now, but what I'm defining in the other side. So I hope online everyone is done here, so that we get the current tax for each year. Current tax liability. It's online. Go there. So current tax liability, you can say the arrangement doesn't matter. Taxable profits, because current tax is taxable profit and tax rate. Yeah. You take the profit, you multiply by the tax rate, which is 30%. So taxable profits, the ones which you have calculated, 200, 700, 1150, 1450. Then tax rate is 30%. Therefore, current tax is the taxable profit times the tax rate. So get those ones, then you will give me the answers there. So I hope you have gotten that. I want us to go to Roman 3. Roman 3 is the one they're asking for the temporary differences. So remember, temporary, how do you get temporary? Yeah? You take the carrying amount minus tax what? Minus tax base. So how do we get carrying amount? Yeah. Cost minus accumulated what? Depreciation. The tax base So we say here, yeah, then carrying amounts. Then tax base. So you will take this minus this. Then you get temporary. Temporary differences. Then by extension, QR, you can even get deferred what? Deferred tax at 30%. When you multiply this by 30, you get deferred what? Tax. So how that? So carrying amount is the cost minus accumulated depreciation. What was the cost of that asset? 4. Year one depreciation was 1,000. So all this will confuse my students. I can make it easier. Let me do this. I hope you understand. So carrying amount, the cost was 4. Depreciation 1. So year 1 book value will be 3. Then you keep on reducing with 1, 1. You understand? So year 2 book value will remain 2 because they are reducing it with 1 year. Yes. 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 The depreciation must be actual cost. Or if it was reducing balance. So you keep on reducing. So 3 minus depreciation year 1, you remain with the 2. Then 2 again minus 1, you remain with 1. Then 1 minus 1, you remain with 3. If someone will forget about that, you can have it this way. That carrying amount which is MPV, year 1, 2009, 2010, 2011, 2012. The cost is uniform at 4. Cost is 4 throughout. Depreciation year 1 was how much? 1. So that value will remain 3. Year 2, accumulated depreciation will be 1 plus for that year. So that is how much? 2. Then here you top up 1, it comes to 3. 1. Then 3 plus 1, 4. Yeah. You accumulate means you keep on adding. So either you just do 1, then you keep on reducing or Tax base. Tax base, the same thing. Tax base, when you go to tax base, that is the written down what? Value. You take the cost, it is the cost minus accumulated wear and tear. Year one, wear and tear was 16. Sure. They are somewhere there. We calculated all the wear and tear. You can see them there. So this one will leave us with how much? 20 what? 28. 24. Then year two, you keep on accumulating. Year two, wear and tear is how much? 12. So 12 you accumulate with 16. It comes to 28. So this one comes to 12. 28 accumulate the next one. 36. 36 coming to 4. 36 plus the next one, 4. Million. So maybe if someone is lost, I'm referring to this wear and tear. This one's here. So these are what you accumulate. 16 year one, 16 plus this for year two. The total you get, you add it for year three, like that. So if there is no concern, those are what you bring here. So you bring here 24, 12, 4, nil. Then subtract. You take this minus this. Hey, I want to finish for me this. You take this minus this. You get temporary. Then what you get as temporary, multiply by 30 to get deferred what? Tax. Hope you have understood. So get temporary and then multiply to get from deferred tax. Finish that. Only one tax. Because if you are accurate, this one is 600. The first tax, the first one. But 60, I mean 60. 60. You see? 600. Yeah. Okay, fine. You have this minus this is 600. 30% of this 180. Then this one, 800 giving us 2. Then this one, 180. Name. But just 0 dash. So that's okay. Vera, that question is not in the first paper. Aye. Then the last, they wanted us to prepare deferred tax account. So let's prepare deferred tax account. Deferred tax account. Have it that way. Be ready. I want us to start. So online, how many forecasts should be here? How many forecasts should be here? On the deferred what? Deferred tax. So because I don't want to keep on changing the camera, allow me to write those figures somewhere here so that online can be able to capture the numbers. 180 to 40, 180, nothing. Deferred tax is a liability. We agree. Liability in the ledger should be recorded on which side? Credits. Liabilities are credits. So in 208, you know the year started in 2849. So on 1st July 2008, balance brought down there was nothing in that account. But by the end of the year is now June 2009. So it started in July 2008, then it ended for 30th June 2009. So we were closing the year, we have gotten a tax of 180. So you close the year, so closing you close the other side. On 30th June 2009, balance carried down is 180. So just give me a minute. When we started, it was 0. When we are closing the year, it is how much? 180. It means during the year, the tax which came up was how much? 180. So to equalize the account, it will balance this side. You come and say to profit and loss. So this one for the year, anything for the year, we take the profit account. So to P&L, that is the balancing figure. We balance it with how much? 180. So that we equalize the two sides, 180, 180. Note that here, then we go to the next financial year. Let's open the new year. So this is carried down. So brought down, this is carried down on 30th June. So brought down will be 1st July 2009. Balance brought down. Balance brought down is the closing, which is 180. Then that year we closed with how much? 40. So you come this side, 30th June, balance carried down to 40. So balancing figure here and then, napeleka ngapi? We check 60. Because when we started, it was 180. At the end, 40. So there was an increase of how much? 60 from 180. So the balancing figure comes to 60. The increase. You understand? So you close that here. Then we open a new year. Oh, this is 20. This one should be 20. That is 20 there. Let's open 2020. Balance brought down to 40. Carried down 2010, which is now 30th June 2011. Balance carried down is how much? 180. So there was a decrease. It decreased from 240 to 180. So that decrease is a tax income. It will balance this side. So here and there, BF is the balance in income. So that is 60. Can you complete for me 2012? Open this one, then complete 2012. Then we check. Try finish 2012. So this is 1st July 20, which one? 2011. Brought down is how much? 180. What you closed with this year. Then 30th June 2012. Balance carried down 0. So the balancing figure is a decrease. A decrease of 180 so that the account can equalize. 180, 180. Have that. So that is how the account should look like. That is how the account should look like. Another illustration, I want us to check another illustration unless you have a question. I want us to check another illustration. So kindly, write down this illustration. I'm sharing in your groups, in your group. So I've shared this in the group. Write down that illustration. The one which starts with ABC. Check. Or you are Yes. So write that illustration, then we can check. Joyce Marshalia. Joy, this illustration there, which I've just shared like 1 minute ago, ABC Limited. Can you people write it? Then we work. So we are remaining with that one. Then from there we do a question in past paper. Then I think we're done with that topic. So write that very fast.
Yes.
So, so we can read, it says, ABC Limited has a deferred tax liability of 200,000 on 1st January 2019. The company provided the following information as of 31st December 2019. So we have the assets, machinery, inventory, motor vehicle, carrying amount, as you can see, tax base, also as we have paper from the same. Machinery had a evaluation gain of 200,000 during the year. Assume a tax rate of 30%. Required, prepare the necessary journals to record the changes in deferred tax. So, to record the changes, first of all, we must calculate the deferred what? Tax itself. So how do we calculate deferred tax? We take the carrying amount, we take temporary times tax rate. And for you to get temporary, you must take carrying amount minus tax base. So have these assets the way they are. You know, this is 1 year with the different assets. So you just say assets. Which ones are they? Machinery, inventory. So there is no need of putting the patterns there because they are assets in the same year. So once you get the total of temporary, we multiply. So have these ones. So give me the differences. Good. So this one comes to negative total. I've added the total because it is just 1 year, but if they're different years, you work with them individually. Therefore, deferred tax liability, when you get positive, positive leads to liability. If it's negative, like this one, if this one was a loan, we only had negative 500. Then this one, if you tax, it will be a tax, deferred tax asset. So, if it's positive, it will lead to deferred tax liability. So, deferred tax liability is 900 by 30%. I think that one should give you 270. So what was the question? Read the required journals. Journals. There are, what did I say? 1000 minus 15. Where? I don't know the one she's saying. Very hope you have seen what you are doing. So to get the journals, prepare the deferred tax itself, deferred tax account. To get the change, because they are saying, okay, to get show the changes, so say deferred tax account, deferred tax account. So deferred tax account. So balance brought down. There was deferred tax in the account. Check, it was 200. So it was 200 when the year started. At the end of the year, we have gotten how much? 270, this one. So now the balancing figure, which don't write, should be 70, but we are not going to capture 70. Now, actually, now that is why I brought in this question. Otherwise, we are not capturing it. There was an element of revaluation somewhere. Sure. Yes, there was a revaluation somewhere. Check where. Machinery had a revaluation gain of 200 during the year. You know, these figures were at the end of the year. During means before the end of the year. So during the year, there was a revaluation of 200. So remember that 200 has been included in the carrying what? Amount. And we said yesterday, if you include it in the carrying amount, it will not affect this, but this one will increase with the proportionate value. So if you increase this by 2, even temporary will go up by how much? 2. So that 2 is also in the temporary. That 2 is also inside the 900. That 2 has also been taxed here. So out of 270, there is how much? 30% of 200 is 60. Yes, 60. 30% of 200 is 60. So inside the 270, there is 60 of deferred tax, which came as a result of what? Revaluation. Because we said yesterday, when you revalue, you need to do what? Tax. That gain. That gain should be taxed. So it is your duty to check that revaluation gain. It had a deferred tax of how much? It had a deferred tax of how much? 60. And that 60 is part of 270. So it is inside here. The problem we are having, or the issue, if you read even from the notes we say, revaluation, you know, when you revalue assets, that's not a normal business income. Sure. That is called other comprehensive income. They are just others. It's not a normal business income. So it goes to the balance sheet as equity. Revaluation is a capital component. So when you come here and say profit and loss balancing figure is 70, that is wrong, because it means you have taken into consideration even what? The deferred tax of revaluation. You need to eliminate the one which was not by revaluation, because revaluation will go to the balance sheet. So you subtract inside the 270, there is 60. That 60 is other comprehensive, which will not go to P&L. So you eliminate it here by crediting the account. So you credit by saying revaluation gave us 30 of 200, which is how much? 60. So what goes to P&L, profit stock loss, balancing figure, how much we take them? 10. So this is, you have understood? So what we made, the balancing figure is 10. So 10 is what goes to P&L. You don't take the whole. You know, if revaluation was not there, I could have taken 70. But the problem, inside that 70, There is 60 which went to revaluation, which should go to balance sheet. So this one here goes to the balance sheet. It should not go to the P&L. That is why I've subtracted. And you subtract by crediting the account. You don't add. You subtract by crediting. That was main issue on that. This was not the question. The question was journal entries to record the changes. Changes means tell us how it came from 200 to 70. How did it come from 200 to 70? There is this one, there is this one. So these are the two things you pass in the journal. Whenever you are asked from journal entries in financial reporting, you are simply being asked which account should be debited and which account should be credited. So right there, journal entries. So debit and credit. So check here. We have credited the factor to what? Revaluation of 60. So the corresponding account to be debited is which account? Revaluation. So debit, revaluation. Reserve account with 60. Because you have credited which account? Deferred tax account has been credited by 60. So you just pull it from there. Then you give me a narration to record deferred tax on revaluation. To record deferred tax on revaluation. That is the first one. Then the second one, the 10. I've credited deferred tax account against which account? P&L. So you go and debit profit and loss account with 10 because you have credited deferred tax account also with 10. To record deferred tax for the year. P&L is always for the year. Have that, then you check. If there's a question, you ask. If no question, we go to past paper. For 20 minutes is enough. What about paper? Physical. Take a photo. So if no question, go to the past papers, April 2022. April 2022, question 5B. Question 5B. April 2022. You got it? Which page? Page 13. Okay. Page number 13. Yes, I'm there. So we can read so that we beat time. Zion Limited, a public limited entity, is in the process of finalizing its financial statement for the year ending 31st of October 2021. Fine. October 2021. Fine. The following information has been extracted from its accounting records for the purposes of estimating the deferred tax balances. Okay, that story we are not reading. Because when you are done reading, you will not even recall what you read. What do they want? Sometimes it's good to know what someone wants. Sometimes, someone gives you a lot of story and you tell them. Can you just say exactly what you want? So instead of this story, can we just know what they want? Can help us. They want us to compute what? The relevant temporary differences. How do we calculate temporary differences? It is the carrying amount minus tax base. We can have that arrangement so that as we read, we can be posting. You get? KCSE was released yesterday. There are some people, some schools where the last person, the last person got the C+. And there are some schools where the third person got C+. This is true. There are somewhere the first got C+, and there's somewhere the last got C+. So what makes the difference is how you approach. You see, like you should be Team Alliance. Someone from Alliance cannot just do these things. This is computation. This is not theory. You be smart. So a smart person, you just arrange. What is the name of this company? So right, Xeon. So if you do like this, the last person gets C+. Not the first, the last. But if you start reading, Xeon Limited, temporary differences. Temporary differences. So to get temporary differences, this is just 1 year. So just write their assets and liabilities, maybe. You don't know whether they are liabilities, but just write carrying amount. Don't know these shillings are in millions. Shillings are in millions from what I can see there. Tax base also in millions. Then you will get the temporary difference. So once you have that arrangement, as you read, you can post anything which makes you happy along the way. Can we start reading? Yes. So inventory is an asset. Thinking begins after you have written what you can be able to see. Inventory, now we read, is stated in the financial statement at the low of cost and net realizable value. The company wrote down its inventory by 120. They reduced stock by 120 million to a net realizable value of how much? 1130. So 1130 is the book value. Sure. Book value, which is the carrying amount. They reduced it by 120 to a net realizable value of 1130. So 1130 should be the book value of that stock. The reduction in value is ignored for tax purposes until the inventory is sold. So when taxman comes, they will disallow. So take 1130, add back the 120. That is what it means. It is disallowed. So add back, go back to the costs. Because when taxman comes, the argument is this. What was the initial cost before reduction? Initial cost is 1130 plus 120. Then once you add, they will ask, did we give you any allowance like wear and tear? No. Then we are assessing costs. Where there is no wear and tear, then tax base is equivalent to the cost of the assets. Which we are. So cross it back. You get how much? 1250. So taxman will disallow. So add back. They are not allowed to reduce. So the difference will just be that 120, which is negative. Negative is called deductible temporary. Deductible. Next, we have number 2. Number 1 gone. Trade receivables. Trade receivables. Those are debtors. Trade receivables. What about them? Has a carrying amount of how much? 450. When you're given, you take it very fast. Carrying amount of 450. After making a general provision for doubtful debt of 30. The provision is not allowed for tax. Add back. Take 450, add back the 30. You know they subtracted, but they were not allowed to do what? Subtract. So in the books they have recorded 450, we have no problem. But when taxman comes, add back the cost. Then they ask, is there wear and tear? No. 400 and what? Right. Even that is deductible. Correct? Number 3, property, plant, and equipment. PPE. Just record it as PPE. Property, plant, and equipment. What about them? As a carrying amount of how much? 3050. That is the carrying amount. And a tax base. Okay. This one is new. Record fast, even subtract. We'll read the rest. Then everything has been given. You can go ahead and destroy. 3050 minus this, you get temporary of 200. Like that. 300. 300. And now we can continue reading. During the year, during means before the end. Property was revalued upwards by 150. That 150 already is here. You know these figures are at the end of the year. So during means before the end. So already that one is here. 150 will just help you when you are doing the far tax account to subtract evaluation and all that stuff. So you know we are good to go. Number 4. During the year, development expenditure amounting to 480 was capitalized. Amortization of 20 was charged, profit and loss. This development expenditure was allowed for tax purposes in full. Okay. So right there, development expenditure, intangible assets. Development expenditure is an intangible asset. So they are saying it was 480, but there was amortization of how much? 20. Amortization is just like depreciation. Subtract to get the book value. So 480 minus 20 is 400 and what? 60. That is the book value. Sure. But they are saying the development expenditure was allowed, meaning the whole amount was allowed. So tax base is what? 0. It is 0. The whole amount was allowed for tax. Allowed means you are not supposed to check anything there. So you just have there 460. Number 5, trade and other payables. Trade and other payables. Trade and other payables are carried at 600. That is the book value. But these are liability. Remember, payables are liability. Creditors. So liability make them bracket. You cannot add. You cannot limit positive with assets. Sure. So subtract the liabilities. So it was traded at 600. Included in the payables are accrued expenses of 100 million, whose related expenses are deductible for tax on cash paid basis. Okay, I know what they are saying. They are saying inside this 6, there is an accrued. Accrued means not yet paid, expense of 100. And that 100 will only be allowed if it has been done what? Paid. If it's paid, it will be allowed for tax. But for now, it has not been done what? Paid. It's still accrued. So it means it shall not be, it has not been allowed for tax purposes. So subtract it out from there. So that is 500. So that 100 will come later. Number 6. Deferred tax liability on 1st November was 272. That was the opening. The income tax rate is 30%. So we are done. Can you get for me the total temporal? Positive. Positive. Extra is 8. That's not 5. Right? 510, yes. Check that. Should be positive 510. Therefore, deferred tax is equal to 510 times 30%. Give me the answer, 510 times 30%. 153. So what was required from 2? Deferred tax accounts. Deferred tax accounts. Balance broke down. How much was the balance broke down? Note number 6. 272. At the end, you have gotten 153. But you remember it was revaluation. So that revaluation, remember, it's affecting this balance. So credit it out to eliminate it from here. So revaluation, it was how much? 150. Yeah. Note number. Check note number 3. Additional information number 3. There was 150. That one is affecting. It has an effect. So 150 by 30% should be 45. So that is 45. So balancing figure goes to P and L, it will balance this side, is a reduction. So P and L is the balancing figure. Then you are done with that question. It's balancing without. $164. So that is one. As simple as that. So that one marks the end of that particular topic. Now check the allocated marks. 5, 4. The first one is 5, which is 1, 2, 3, 4, 5. Then this one, 1, 2, 3, 4. There is part A of the question up there, which is different from this. You see? There's part A of it up there. Huh? Yes. So that is it. So when we meet in our next class, we shall start on a new topic. So right here, topic IFRS 9. Financial assets and financial liabilities, popularly known as financial instruments. No, the fact that I told you, I think I told you before, they were not examining. They started on 2022. There are no questions there. So Vera, you are saying something? To get the recording for yesterday. What happened? Those who are there can attest. Our computers, they Zoom. They wanted us to upgrade, I don't know to what. So the class was ending after I don't know how many minutes, then people log back. So when we start recording, it was disappearing. The only recording which will now be okay is from today onwards. It was, the Zoom was, I don't know, they wanted us to make some payments. Like the ones, they wanted that to upgrade because we were, yeah, the subscriptions, which we have not done. Then there is tax, which they had adjusted. So we had to adjust. So we were having challenges after 40 minutes, it was going off, what, all those stories. So when you start recording, if it goes off, problems. But yesterday we did much of right. Someone can share the notes for yesterday in the group. But the recording from today will be available. Thank you and have a nice weekend.